Alright, let's dive into what's happening in the markets right now because, honestly, it's a bit of a waiting game. The S&P 500 futures are barely moving, and that's not just a random fluctuation, it's a reflection of the broader sentiment out there. Investors are sitting on their hands, analyzing earnings reports and, more importantly, waiting with bated breath for the Fed's rate decision. Personally, I think this pause is fascinating because it shows just how much the market hinges on central bank moves these days. It's like everyone's frozen, waiting for the Fed to make the next play. What makes this really interesting is that it's not just about the rates themselves but what they signal about the economy's health. A hold on rates might suggest the Fed sees stability, but a hike? That could mean they're still worried about inflation, and that's a whole different ballgame. Now, let's talk about earnings because they're painting a mixed picture. Ford Motor, for instance, just crushed it with a 5% jump after beating expectations and raising their forecast. In my opinion, this is a bright spot in an otherwise uncertain environment. It shows that some companies are still firing on all cylinders, even with economic headwinds. But then you've got Visa, which slipped after underwhelming guidance. What this really suggests is that not all sectors are created equal right now. Consumer spending might be holding up in some areas but faltering in others. If you take a step back and think about it, this divergence could be a sign of deeper consumer behavior shifts that we're not fully grasping yet. The Fed decision, though, is the elephant in the room. Traders are pricing in a 70% chance that rates stay put, but here's the thing, markets hate uncertainty more than anything. Even if the Fed holds, it's the tone of their statement and Kevin Warsh's press conference that could move markets. From my perspective, a hawkish tone could rattle things more than a rate hike itself. Why? Because it would signal that the Fed's still in fight mode against inflation, and that could spook investors who are hoping for a softer landing. One thing that immediately stands out is how narrowly focused the market leadership has been lately. Julia Hermon from New York Life Investment Management hit the nail on the head when she said markets might be overestimating inflation risks while underestimating the fallout from further tightening. That's a perspective I think more people need to hear. Meanwhile, the Nasdaq's losing streak is hard to ignore. 5 straight days in the red, dragged down by cheap stocks. That's not just noise, it's a trend. The VanEck Semiconductor ETF dropping 9% in a week is a red flag. What many people don't realize is that semiconductors are often a bellwether for tech and global demand. If they're struggling, it could mean bigger troubles ahead for the sector. Personally, I'm keeping a close eye on this because it could be a canary in the coal mine for the broader tech industry. Lastly, let's not forget about the earnings still to come. Microsoft, Meta, Qualcomm, these are heavy hitters, and their results could set the tone for the rest of the week. If you ask me, these reports will be less about the numbers and more about the guidance. Are these companies seeing a slowdown? Are they optimistic about the future? That's what the market will be hanging on. What this really boils down to is a question of resilience. Can these tech giants keep delivering in a shaky economy? I'm not sure, but I'm definitely watching. So, where does this leave us? In a holding pattern, for now. But here's the thing, markets hate stagnation. Eventually, something's got to give. Whether it's the Fed's decision, earnings surprises, or a shift in investor sentiment, volatility is lurking just beneath the surface. My closing thought. This calm before the storm is the perfect time to reassess your positions and prepare for what's next. Because when the dust settles, the market will move, and fast. The question is, which way will it go? Let me know what you think in the comments below.